Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning at 7:10 Mountain Time on October 3rd. This is the preview video summary of our weekly note, which was titled Far From It. That's a reference to Chair Powell saying that a December rate cut was far from a foregone conclusion. That was one of the two clear hawkish policy steps that the Fed took last week. That one was driven by what we're calling the regional revolt. The dissenter, Kansas City Fed President Schmid, Cleveland Fed President Hammack, who had wanted to dissent against the September rate cut. We presume she was the only dot that was looking for no rate cuts this year and has said that she does not believe she believes financial conditions are easy and the Fed policy is not restrictive. Couldn't disagree more strongly with her. And then, of course, Lori Logan from the previously from the New York Fed Markets Group, now president of Dallas, is also saying she doesn't support further rate cuts at this point either. But the other step that was much widely less recognized was the decision to reinvest all mortgage paydowns, which are running at $17.5 trillion a month over the last 4 months or so, really through the course of the year, into Treasury bills rather than notes. This didn't get a lot of attention, but it is effectively an increase in supply in the belly of the Treasury curve. We'll call it another $17.5 trillion of 5-year notes every month. The current issuance schedule is about 70 of those, so it would be as if Treasury Secretary Bessent decided to increase that by $17.5 billion to some $87.5 billion, a not insignificant amount of Treasury supply. This was a lot of what we discussed in this note was the Fed's management of the asset side of their portfolio. They still haven't made a decision on what they're going to do. The duration is overly long. They don't hold any bills. It's contributing to the pressure on repo rates that's getting so much buzz on the X platform, for example. The Fed really doesn't have a good handle on managing the asset side of their portfolio. They claim after all these years, going back to 2008, that they still don't really understand those risks, in which case we actually recommend that management of the Fed's asset side of their portfolio be transferred to the Treasury, who can put the personnel in place to actually manage that appropriately, coordinate it with debt issuance, and get a better handle on this mountain of public debt that we have. I know lots of people will say that's a scary thing, but the Fed does not have an exemplary record around managing this either. Bottom line here is the hawkish steps that the Fed took does risk a late year risk-off kind of equity market correction driven by higher interest rates. And so we're watching, even this morning, Treasury curves up another 3 basis points or so. We disagree with the Fed's outlook on the labor market. We disagree with their assessment of financial conditions. They don't really understand the balance sheet. They don't know how that's contributing to easy conditions for assets that are priced off longer-term treasuries. But conditions still remain tight for floating rate borrowers, small banks, small businesses. And if and when we get the government shutdown over with, we get that data, we think that will be the key to getting them back on track to cutting in December and continuing to cut at least to about 3% or so. That eases a lot of that pressure on small banks and small businesses. So that's really an ongoing theme for us, and it continues to be the case. And we just think the Fed is off base on this. We then have a pretty good discussion about bank capital and how that's really the main determining factor in this $3 trillion of reserves and the questions about repo rates and whether we should have a scarce or abundant reserve regime. Become a subscriber. You get all the details on that. But there is going to be bank regulatory loosening. Chair Powell's slow walking, and it may need to wait for the next Fed chair. The candidate that's talking about that the most is Warsh. Obviously, Bessent is qualified to talk about it as well, but Bessent, Moran, Warsh have all made comments about this, and it makes it very clear we're going to have a looser bank regulatory environment for the big banks. The moves that were undertaken after Dodd-Frank did not make the system safer. They just pushed risk into more opaque portions of the market. So we then went on to discuss the regional Fed surveys, some of the labor market data that shows that the labor market clearly is weak. And then we wrapped it up with a pretty detailed discussion of earnings and how the bulk of earnings looked really weak. It looks really weak. The equal weighted S&P earnings growth is only about 6%. Typically in the middle of the business cycle, it would be about twice that. Valuation for that sector looks cheap, but that's because earnings growth is so weak. Staples earnings are probably the single best example of the impact of the triple policy shocks, immigration, trade, and government spending. Those Staples earnings are tracking up 0.6% only on 4% revenue growth, so clear margin pressure. And then we went on and talked about big tech and how they're starting to increasingly use debt. Even this morning, we saw Alphabet debt issuance and how that's not a problem yet. But in 2026, we expect that to begin to put pressure on credit spreads. So if we get the data that we are looking for in the labor market and the Fed does get back on track to cutting in December, that will go some ways towards getting to that run it hot, faster growth scenario in 2026. But we'll likely get a pretty good pullback in early 26 if the Fed doesn't prompt one late in 2025. So we're a little bit incrementally more cautious. We didn't take any significant policy steps this month. But if it looks like we're not going to get that data before the December meeting, we may look to cut risk in the next couple of weeks. Barry Net from Ironsides. Have a good week, everyone. Thank you.